So we are back. The acquisition of the subsidiary of the ordinary shares in S was through a share exchange of one ordinary share in H Limited for every 2 shares in S Limited. The market price of H Limited and S Limited shares as at the date of acquisition were shillings 30 and shillings 18 per share respectively. In addition, H Limited agreed to pay a further amount of shillings 25 per acquired shares in S Limited on 1st October 2021. H Limited cost of capital is 10% per annum and 1 shilling receivable in 2 years' time as a present value of 83 cents. H Limited has not yet recorded the consideration on acquisition of the ordinary shares in S Limited. So the draft financial statements of the group companies, so statement of profits, as you can see, and even the statement of financial position. Let's go to the additional information. At the date of acquisition, the fair value of S Limited's identifiable net assets approximated their book value with the exemption of an item of plant which had a fair value of shillings 200 million above its carrying value. That one we said is what? That is revaluation. So we can even capture. We can even capture. Charity, I hope it's okay. We can capture in note 1. You can even say in note 1 there is revaluation. That is revaluation gain of how much? From 200 to. Then you continue reading. The plant had a remaining useful life of how many years? 10 years. So, fine. Depreciation on plant is classified as part of cost of sales. So, depreciation. In fact, this is depreciation under charge because they were not depreciating the asset before. So, you need to charge depreciation on the revalued amount. So, that is 200 over how many years? Over 10 years. But subsidiary is how many months old? When was it acquired and when is the year ending? The subsidiary, check where the question started. The subsidiary was acquired on 1st October 2019 and the year is ending on 31st March 2020. So subsidiary is how many months old? 6 months. October, November, December, January, February, March. So this is how many months? 6 over 12. Because if you get, this is 20 per annum. So times 6 over 12, that's going to be 10. It's got my fine. Okay, then we proceed. In the same note, the fair value of the plant has not been reflected in S. Fine, we'll reflect. No fair value adjustment was required in the acquisition of A, no problem. In addition, at the date of acquisition, S Limited an internally generated brand, which the directors of H believe to have a fair value of 300. The brand has a useful life of 6 years. Amortization charge is classified as administrative fine. So amortization on the brand will be 300 divided by how many years? 6 years, but for 6 months, giving you 25. So there is amortization. And amortization, they have said we classify under what? Admin. Correct. Thank you. Let's go to number 2. Immediately after acquisition of S Limited, H Limited invested into 50 million in an 8% loan note of S Limited. All interest accruing had been accounted for by both the entities. S Limited also has other loans in issue. That one has no big issue. That one will bring intergroup debts. What you can do, a book petition match for profit account. People are saying the board is blinking, so it is not stable. Maybe it will be stable as we proceed. When you check profit account, are you seeing somewhere they have written investment income? Are you seeing investment income? In brackets, investment income, they have said. We have interest and dividends. There is a problem online. Vuta camera. Vuta camera ni kufanya nini? F, yeah, F. I don't know what the problem is. Ama nizime stima. Online, is there any change? People don't say, will you go and see me? That is the question. Huh? I mean, so if we use that natural light, this one better. Wanasema nivute camera with a clean cloth. Clean cloth ni gani? Oh, that panguza camera with a clean cloth. And if our clothes are not clean, huh? So what to be a light? Where's our problem? But why today? Why this misgiving today? It is better. It is better now. Online. I'm going to phone it. They are saying now it is better. So where were we? Dot number? Oh yeah, I was telling you, we check investment income. Yeah. In the investment income in bracket, they are saying interest and what? Dividends. So my issue will be the interest which they received internally will subtract. So you're aware of that. So that note number 2, can you check for me how much interest we'll get from that loan note? When I will be consolidating, in the investment income, I will subtract that interest. So you come here and say, interest on loan notes. Interest on loan notes, 8% times what value? 250. But 8% is per annum. Sure. Yes. So for 6 months. So from the investment income, you will subtract because that is an intergroup interest income. So 8% times 250 by 6/12. What do you get? You get 10. So that 10 you will subtract. You remind me when we are consolidating, you subtract that interest. Let's go to number 3. After the acquisition, S Limited sold goods to H for 500. That is upstream. So whenever you're adjusting for UPI, remember NCI. S Limited had marked up these goods by 25% above cost. H Limited had 30% of these goods in the inventory. So they want us to determine unrealized profit on inventory. The one which we call what? UPI. So this was not 2. This was not 1. This is not 3. So UPI will be the goods, the profit margin. So profit margin they have said 25% above cost. So 25% above cost is 25 over 125. To convert it to margin, 25 over 125 times the goods which remained in the store. They have said what percentage? 30% times the sale value. The sale value of those goods was 500. Correct. So our unrealized profit will be how much? 30. Good. Good. We go to note 4. H Limited's policy is to value the non-controlling interest of S Limited at its fair value at the date of acquisition. At the date of acquisition. For this purpose, the market price of S Limited shares at the date of acquisition is considered to be representative of the fair what? Fair value. The market price of S Limited shares is assumed to be the representative of the fair value. So what you do, you can tell me here, this is note 4, fair value of NCI. They have said the market value of S shares is the representative of their fair value. So can you check the equity, equity, the ordinary shares of S? Ordinary shares of S, we are seeing how much? 5, eh? But I want the number of shares first. So divide by the par value, we are talking of 500. But NCI, parent was controlling what percentage in S? Parent, 80. So minority are controlling 20%. 20% of the 5, but they have said we multiply with the market value. What was the market value of S Limited shares? It was given somewhere where the question started. In paragraph 2. 18. Yes, it was 18. So NCI, that will be their value. They have said the fair value of NCI is represented by the market value of the shares. But NCI was controlling 20% of those shares. So just take 20% of the shares, then multiply with the market value. Coming to how much? 1,800. Good. We proceed. Let's go to note number 5. Impairment test was carried out, which concluded that due to poor trading performance, the investment in A had been impaired to the extent of 80 million. So note 5, there is impairment. Impairment loss in associates. It was in the books of A. It's equals to 80 million. This one will be classified under what? Under administrative. That one you will take under administrative. So that one has no problem. In fact, I will not even bother to work goodwill at this stage. It's not. And if you work it, it's not very relevant for P&L. P&L, we only compute goodwill to get what? Impairment. So if impairment is there, no need to waste time. Number 6. S Limited paid dividends amounting to 400 before the year end. S paid dividends. So when S pays dividends, what happens? The parent takes their share. So note 6. Dividends from where? From S, sure. So from S, parent will take the percentage they are controlling. They'll take what percentage? 80%. 80% of 400. That is 300 addition. Now your dividends, examiner said they are classified it under what? Under investment income. They classified both dividends and interest. So you will subtract as intergroup dividends, as intergroup what? Interest. Last, no, not last, number 7. Yes. Even hata wametusaidia wamesema in bracket interest and dividends. So they receive whatever they got internally. You have to subtract as intercompany.
So both 320 and 10.
Yes, both 320 and 10 will be subtracted. Yes. So that we get what came from outside, the difference. Number 7, all income and expenses of the 3 companies are deemed to accrue evenly over the years unless otherwise specified. Evenly means uniformly, equally, proportionately. So actually hiyo unapewanga ndio uamke kidogo mbio that the P&L profit account should be done what? Should be apportioned, time apportioned, because the subsidiary, when was the subsidiary acquired? It was acquired on which day? When are the financial statements ending? March. Meaning it should start when? April 2019. So when was the subsidiary acquired? Where the question started, 1st October 2019. That is when it was acquired. What about associates? They said on the same date. Sure. Yes, they said on the same date. So both S and A were acquired here. So for the P&L, at least now that is what can make you to fail that question. P&L profit account, you will only take this portion from October to March. But balance sheet, you don't apportion. You cannot apportion assets. So assets you will take for the whole what? For the whole year. So for the income and expenses, you only take for this period. That is what you need to know. So you take these 6 months. Correct. So that is, it was just a wake up note. When you see once you hear examiner trying to say evenly, always be very keen. So you don't end up adding in full while they were supposed to be apportioned. Note 8. Other than share exchange in the acquisition of ordinary shares in S, there were no other issue of shares by the group companies. So, no problem. So, what can bar us from starting? Nothing. But I would like to compute goodwill. There is a reason why I want us to calculate goodwill. Did we calculate? The reason why I want us to calculate goodwill, there was a deferred consideration in that question. There's amount which was to be paid in 2021. Sure. So when you defer, there is always cost for deferring. And that cost of deferring is treated as finance what? Finance cost. It will affect our interest here. So let's calculate goodwill, then we can kick off the presentation. So goodwill computation. Net goodwill. So shillings are in thousands, millions. One of my nature is akuna rushing. Can you check for me the formula? Can you go through your books? How do we calculate goodwill? So that as we calculate, and if you know, you can start bringing some. So when calculating goodwill, you take the purchase what? Consideration, then you subtract share of net assets. And net assets are the equity components. So let's come here and say purchase consideration. Purchase consideration in this question has a lot of issues. We have to be keen, otherwise we check. Yes.
Again, in that one,
Yes.
there was acquisition for, we have associate.
Oh yeah. So associates, let me clarify this. Associates, their goodwill is not taken in the books. We only take our investment. In some questions, you will see me working the goodwill of associate. Then in the balance sheet, you will realize they are not captured. The main purpose is to get impairment. Impairments.
So if there is nothing that is then
No. If there is no impairment for associate, there is no need of calculating their goodwill because we are going to calculate the investment. But here I'm ignoring because already we have been given impairment in associate somewhere, 80 million. So later when I will go to the balance sheet, I will just calculate our investment, then I reduce the investment with the 80 million impairment. So goodwill of the associate is only relevant for you if you want to get the impairment. If the examiner said that goodwill in associate was impaired by 10%, they now calculate to get impairment. Then that impairment will help you compare. So here there is no need. So purchase consideration. Let's put note 1, paragraph 1, paragraph 2. On 1st October 2019, H Limited acquired 80% of the ordinary shares in S when the retained earnings of S was 53.35. So that is the pre-acquisition retained earnings, the profit on the date of acquisition. So that is the profit used for calculating goodwill because we said and we agreed and it is known that goodwill must be determined on the date of acquisition. So that is the profit you use when calculating what? Goodwill. Then you forget about it. On the same date, H Limited acquired 40% of A, paying 16, no problem. The acquisition of the ordinary shares of S was through a share exchange of 1 ordinary share in H for every 2 shares in S. So they gave out shares to acquire. And how are they acquiring? They give you 1 for every 2. For every 2 which they have acquired. So you get 1 share for every 2. The market price of H and S were what? 30 and what? 18. Issue of shares. They were giving 1 share, wanajifanya superior, 1 share for every 2. And you know they never acquired all the shares. I hope you're aware of that. The minority took 20%. So parent took 80%. So they gave 1 for every 2, but of what they acquired what percentage? 80%. 80% of 500, not 5,000. We took 5,000 divided by what? 10. So we are dealing with number of shares. Then what you will get here is the number of shares the parent gave out. But what was the market price of those shares? You got that?
Yeah. It was that for the parents. I thought we are trying to acquire shares
from S. Yes.
The price.
Nani wanapeana shares? Who is giving out the shares? To the parent. Parent is the one giving shares to acquire.
You remember when I was
yes, I clearly remember. You know, you are taking me back to Ile composition primary. I clearly remember it was one Saturday morning when you requested. Yes, I remember. You use the market value of the acquirer. Parent is the one acquiring. So, you know, acquisition, you give shares. Unapea wale shares they were join. So instead of giving them cash, we gave them our shares. And we were giving them on this basis. we give them 1 share for every 2. You know the notion, which is not true. The notion is for you to be acquired, you are suffering. Your company is not very stable. Hata hizo shares zenyu haziko sawa sana. So mbili mkuje tuwapatie moja. So parent is giving them 1 for every 2, but not for the whole 5, because NCI remained with 20. So on the 80% of the 500. Ali, that is what I'm explaining. Then you multiply.
We have the issue of 80%.
80% are the yes, 80% are the number of shares you have acquired in that company. You see, you want to give them out shares to join. So you are giving them shares to join.
Let's put the issue of sharing, the issue of giving out shares. In the normal situation, the holding company could have acquired 80% of 500 shares.
True, which is 400.
Which is 400.
Yes.
Now let us come up to the issue of this giving out and that is where, because actually when we are combined.
Okay. Let me take this
For example, when you acquire 80%.
Kidogo tu nikienda hivi unaweza elewa. Wacha niende hivi uone unielewa. Normally you are talking of the normal circumstances. Parent was to acquire 80% of 5. Then examiner anakuambianga the purchase consideration maybe was shillings 2 million. That 2 million is always meant to compensate the shares they are doing what? They are acquiring. But here they are not giving out what? Cash. Instead, they are saying those shares we have acquired, the 400, tunawapatia nini? Shares zetu. Now walipi, they are not paying.
So meaning the 400 that you are going to acquire, the subsidiary will still have a share.
No, this ones they are not paying for them. Wakienda wanaenda kuwa na shares sasa huko kwa parents, because now they have been acquired, but now they are being given shares. You see, I'm acquiring your company, then I'm telling you, instead of me paying you, wacha nikupatie nini? Shares, and I will give you 1 for every 2. So unaona hata ukikuwa na percentage yako hapo haitakuwa kubwa, because shares zako zina 2 inakuwa 1. So the parent is saying, we don't have money to compensate the 400. So what we are doing, we'll give you shares. Then we check what is the market value of those shares we are giving you. So those shares we are giving you, each is valued at how much? At 30. But we give you 1 for every 2. Siko sawa? Ama? Ukikaa chini, ukishakula saa 8. Ukae chini ama itaharibu. You get 1 for every 2 of what you have acquired at start. I'm being told by Collins 6,000. Yes, but I can see people saying it is now clear. The board clear ama explanation imekuwa clear. What is clear? Then Aisha, let's continue reading. In addition, H Limited agreed to pay a further amount of shillings 25 per acquired what? Share in S Limited on 1st October 2021. After how many years? October 2019 to 2021? 2. So those are 2 years. So after 2 years, they want to pay shillings 25 per every acquired what? Share. H Limited cost of capital is 10%. Shall check what you are saying? 10% per annum and 1 shilling receivable in 2 years' time as a present value of 0.83. We confirmed last time, just maybe if someone was not there. The 0.83, you know, you need to discount because this money is payable in future. So examiner ameshakufanyia, it's 1 plus R raised per negative n, which is 2. So when you do this, you will get 0. What? Charity, fine. We'll give you that back. Even I'm recording, so there's no problem. 0.83. So deferred consideration, because they are paying in future, deferred consideration. In future, they want to pay shillings how much per acquired share?
25.
25. They want to pay shillings 25 for every acquired share. The shares which were acquired, we acquired how many shares? 400. So 400, which is 80% of what? 80% of 5. That's the what? But you discount at what? 83 cents, which is 0.83. So you multiply by 0.83 to discount them to present value. To discount present value, which is 1.1 raised by -2. What do you get? 8,300. Then you add fair value of noisemakers. NCR, they have their fair value on acquisition. Check note number, working in note 4. Note 4 working, and even note 4 in the question. So just check the working because we have already done it. We got how much? 1,800. So the total purchase consideration should be that one. How much in total?
16,100.
16,100. Then we less net assets acquired. So net assets acquired, you should always know them at your fingertips. So you put ordinary share capital, share premium, retained earnings and revaluation on the date of acquisition. So go to equity of S and pick them. Go to equity of S, pick them there. Ordinary share capital, so 5. So it is 5. Then share premium is 20, which one? 25. Retained earnings, kindly consider the retained earnings on the date of acquisition. Even those shares on the date of acquisition, even the two, they don't change. The shares don't change. That's why we're just considering that. So profit on acquisition in the paragraph 1, 53. Are you seeing it?
Yes.
Then there was revaluation. Revaluation, there are 2 of them. In additional information number 1. In the additional information number 1, there was revaluation of plant by how much? 200. And also the brand. Brand had been revalued because in the books there was no brand. That day is when they realized there was a brand with a fair value of how much? It was 300. If you read note 1, you will see there was those 2 revaluations and there is nothing. So add, then we subtract. The difference is goodwill. How much the total net assets? 13? 33? Goodwill? 2765. Yeah. That is goodwill. That is goodwill. There are some accounting treatments which I told you in the notes, maybe you forgot. All right, this deferred consideration. This one is treated as non-current what? Non-current liabilities. It is payable in future. Yes, it's a long-term liability. They will pay in future. So when we go to the balance sheet, remember to bring that. And when you defer, there is always cost for deferring. So after goodwill, you can say finance costs on deferment. Deferment. Yes. 10%, the cost of capital was 10% of that deferred consideration of the 8,300. So that is a 30. That one you need to expense. You don't just defer the way you want. There is cost for deferring. So when you defer, you have to charge that one. So this one will go to P&L, profit and loss account. Kusha, I think we have analyzed that question properly. There? So 10%, the cost of capital. So we can do presentation. So right there, H group. H group. H group, consolidated statement of profits or loss. For the year ended when? Have that chap. There.
As we do the presentation of
No, P&L always weka skeleton. P&L you have to go one by one. Your skeleton tulifanya last time ni balance sheet peke yake. But P&L there are those which are always straight. The ones which are straight nakonga distribution and income tax. Mostly nowadays they wanajaribu kusumbua finance cost, but finance cost like this one you will have to add the finance cost. So the ones which are always sure bet in P&L is distribution, finance cost, and income tax. Those three you should not miss. Upate hizo tatu, alafu ng'ang'ana na watu kwa hizi zingine. Sawa? Haya. So wewe unataka hizo za sure bet kwanza? Riaso. Yeah. Which Riaso? Alright, so let's kick off. Let's kick off revenue. Remember, subsidiary is 6 months old. So all the income and expenses of subsidiary you only take 6 months. I know, kama kuna mtu alianguka hiyo sitting, that was one of the issues. Mtu aleta add this plus this total. Alafu anatoka kwa mtihani ndio kwa example mnaanza kupata mtu mlikuwa naye kwa class. Namwambia wow. Round hii group imekuwa sawa. Alafu anakuambia by the 8 is nice. However, kama mtu angeona hiyo 6 months at what? Hiyo 6 months apportionment. Hapo ndio unachoka. So make sure before you prepare P&L, check when the subsidiaries were acquired. Are those months we always count them using our finger. See ati unachukua this minus this. Ni ukue sure. Let's maleze hii sasa kuna kitu kubwa imebaki. Revenue We take 25,200 plus 18, but 18 we are taking for 6 months, minus sales, group sales which came after acquisition. How much was the intergroup sales? Which note? Note 3. After the acquisition, S sold goods to H for how much? No, not 3. Additional information number 3. So in revenue, we always subtract intergroup what? Sales. Yote, hata usisongange ati sijui unrealized apart and bring another confused. From you said the way it was. So it was how much? 500. Whatever you have sold internally is not a sale. The strength is measured by external transactions. So 18, that is a half, that is 9,000. 9,000 plus 25 is 34,200. 34,200 minus 5 is something. How much? 33? 33,700. Good. Proceed. Cost of sales. Cost of sales 15,120 plus 12,000. 12,000 for 6 months minus, I told you again, we subtract this one. No. Again, you subtract the intergroup sales, then you add back the unrealized what? Profit to reduce the sales to cost. So minus 5 plus UPI. UPI was how much? You have the figure? 30. So add back 30. So when you add 30, it will come for 70. So it's like you're subtracting for 70. Sure. Then once you have captured UPI, please always remember depreciation. Depreciation. That is the one which people normally forget. And even they say depreciation to be classified as part of cost of what? Sales. So there is an item which was revalued and which ought to have been depreciated. So check how much was the depreciation, then classify it as part of cost of sales. You don't subtract, you add, because they are not depreciated. It was how much? The depreciation? 10. So add here 10. Then the sister of depreciation amortization, they said we take it to what? Administrative, which is okay. Chapa here. 2660. So this is 2660. Subtract. So gross profit is how much? Gross profits 13,040. Proceed. Associates. You remember associates? Bring them here. The share of profit after tax. That is always an income on our side. So you say share of associates PAT. So you check in that P&L, how much was the profit after tax in associates? Then you take your percentage. We normally bring that one as income. So associate, what was their profit after tax? It was a loss. They made a loss of how much? They made a loss of 600, but we are only taking that loss for how many months? 6. So times 40%. So 40% of that loss. How much is that? 120. So no problem. If you say profit, negative profit, some accountant will know that is a loss. Then bring for me investment income. Here in media, investment income. How much was their investment income in the books? They had recognized how much? 330. But the 330 They said it includes what and what? Interest and dividends. But we said the interest which was internal, we subtract. Ilikuwa ngapi? We calculated 10. Yes, it was 10. Then dividends which came internally to 320. Yes, dividends which came internally 320. So these ones came from group members, the 320 and the 10. Those ones is less. So what remains is what came from outside. That is what we need to consolidate for. How much is remaining? 0. So hakuna difference. Proceed. Shikilia your format. Distribution cost. Distribution cost. Very fast. 1344 plus 840, 6/12. What do you get? You're not paying up. Eh? 1764. Give us here. Admin, where are you? So administrative, you add 2196 plus 1080, 6/12 plus impairment. Impairment was 80. You remember? Tulipewa mahali somewhere. Impairment should be classified as part of administrative. So plus 80 plus amortization. Even amortization, we were told to capture an administrative. How much was amortization? 25. Amortization was 25. So you can indicate in your book there, impairment, amortization. How much is that? Yes. Yes. So we add. Even administrative is in quotes. It's part of the expenses. How much do you get? 28. 2841. Proceed. Finance cost. Finance cost will be 220 plus 150, 6/12 plus. You remember the cost on deferment?
Yes.
Yes. When we defer, there is a cost. You cannot just defer like that. 830. Yeah? Distribution is wrong. So distribution, I'm told, is not accurate. It should be how much? 420 plus 1344. 10. Yes, yeah, that. See, 420. 1764. So this is 840 by 6/12, so they have 420. 420 plus 13. Because how? Kama kuna mtu amemsaidia kuraba. 17 44 64. Finance cost. Finance cost will be, that is 75. 1125. So profit before tax, PBT, how much? Profit before taxation. Profits before tax, you start from 13,040. What do we get? Alice, 71.90.
Yes.
71.90. Income tax. Income tax. Income tax, 1,800. 1,800 plus 12. 12, 6 over 12, 624. 24? Yes, no? Yes. So, meaning PAT will be how much? Profit after taxation. Okay. 47.90. Then, now we are just sharing the profits. P&L ends there. So, you come and say, profit attributable to who? NCI. In fact, it should be a working, but I'm not going to waste my time with that working. It's something which you can understand. NCI, I told you, they take the profit after tax in the subsidiary. So, they don't take the consolidated profits because consolidated includes those of the parent. NCI should not take parent's profits. They should take the profit in the subsidiary. Then you adjust with those things I told you. UPI, impairment, depreciation, and amortization. Those are what you adjust. So I'll take 20%. How much is the profit after tax of the subsidiary, which your eyes can be able to see? Profit after tax in the subsidiary. 27? 27.30. But 27.30, that is for the whole year. Subsidiary is how many months old? 6 months. So they take 20% of that profit, but you check. Sikuna mali S waliuzia H. The goods. Who sold those goods? Can you check? Who sold the goods? So S waliuza. If S sells their profit is affected. So this profit is not accurate because they sold, then there was unrealized profit. So that unrealized profit is subtract. It was 30. So UPI was 30. Yes. It was 30. Then there was also amortization. That brand was in whose books? Your brand. It's in the S. Yes, there was amortization. Amortization was how much? 25. Unatoa hiyo 25. Then depreciation. There was depreciation of 10. Whose asset was that? Whose asset was that? Whose asset? Hiyo tu ni not one. Silikuwa S. Yes. So that depreciation of how much? 10. So you subtract the depreciation. Question. So can you work out that? So I'm getting answers. They're saying 260? Yes, you're 260. Aye. 260. So it means the parent will go with holding company takes the difference. 47.90 minus 2 what? 260. Huh? 45. 45.30. 47.90. Nani hapa na swali? Who has a question? We are done with that. We want to go to the balance sheet unless someone has a concern. That thing is not correct. You know why? Na tulifanya. Kulikuwa na intergroup loan note. Check intergroup loan note. We calculated note number in our workings. It was not, which note? Let's just amend to do the right way because we don't have option. Note number? Note 2. There was 8% loan note. Now that loan note was internal. So 8% of 250 for 6 months gave us 10. So that 10, you know, it is a finance cost. So that finance cost is, yeah, we're supposed to subtract that 10. Please, let's just do the right thing. It's the truth there. We need to subtract that 10. Because that loan note came internally. It was an internal loan. So the interest you are paying among yourselves, you're supposed to subtract, which even we did here in the investment income. I don't know why I watched it there. So 1125 minus 10, 1115. So just make that adjustment so that we do the right thing. Impairment we did, Julie, and impairment we can't adjust it here because it was impairment in the associates. NCI are only the subsidiary. Una NCI for associate. In the associates is the NCI. So if you amend, instead of 7190, instead of 7190, we should have 80. 7180. So the change is not that big. So 7180 minus 24. 47? 80. NCI remains the same to 60. So the parent, you are Kapunguzwa. 4780 minus 260. 45? 20. Thank you. So, Julie, you have seen your sour. That is okay. Let's go to the balance sheet. Let's go to the balance sheet. Let's go to the statement of financial position. Online, I want to change the camera. So right there, H group, consolidated statement of financial position. Consolidated statement of financial position as at. So I'm changing the camera. All right, so we start non-current assets. You audio tunakopi kila siku. As we now we have time, we can just go as we adjust. So non-current assets. Non-current assets. Non-current assets, we have which ones? We have PPE. So property, plant, and equipment. What do we have? Hakuna apportionment for balance sheet. Balance sheet, you don't apportion. You don't apportion the balance sheet. Joyce, I'm not understanding what you are saying. You're saying that PBT, profit before tax, is 7,200. Is 7,200? Hey, Joyce is saying something. I don't want to proceed when we have not checked because it can affect us ahead. Joyce is saying this PBT should be 7,200. Na mwenye alitupea sahihi amenyamaza kama si 72. Okay. Just confirm. Hakuna bio, just confirm. Alice has confirmed that it should be 72. Na kuna mtu alikopi. That is dangerous. So it means PAT. Alice is saying PAT should be 48. 48. So ni pale tu bado wana change. So when you are going to copy, thou shall not copy. So you want to calculator. So 48 minus 260. 45. Hii 2 inakuwa 4. Then you go back to 48. So see if you're rectified. Let's go to PPE. So balance sheet, we said there is no apportionment. You take them in full, even if it was acquired today in the morning, and books are being closed now. So this is 25,000 plus 16,300. What you need to adjust, there was revaluation. Revaluation was 200. And depreciation on devaluation was 10. True. Don't copy again. Make sure umeona. The spirit can lie. Depreciation was 10, eh? Yes, and revaluation was 200. Yeah, that is okay. So this is revaluation, this is depreciation. We read those workings. You have all of them. You there? 41,490. 41,490. We proceed. Investment in A. Investment in associates. Now that is a working we have to do. We don't have any option. So, but it's not going to be very hard. Have a working outside there. Say investment in associates. I want to do it here because of online. Then I'll run. But if I can't, investment in associates. In associates. So you have to get your investment in that associate company. So investment in associates is not going to be that serious. How much did we initially invest in that company? So umetupea hapo kwa non-current assets. Investment in A Limited, how much? 1920. So you say initial investment, you know that is not consolidated, 1920. That was the initial investment in the associate. Then after you invested, any profit which will come after acquisition, you take your share. So you say add post-acquisition. Post-acquisition what? Profit, correct. Post-acquisition profit is any profit they will have after acquisition. So any profit they will have is this one here. They were acquired here. So the profit they will make for this period, you take 40%. So check their P&L. In their P&L, for the whole year, associate made a loss. Sure. They made a loss of how much? 600. So for the 12 months, they made a loss of 600. So for the 3 months, they made a loss of how much? So the 300. The examiner said evenly. Yes, so your portion, 600 times 6 over 12. So your portion. So post-acquisition profits will be, they made a loss for the whole year of 600 times 6 over 12. Then we will share for them what percentage? 40. You share for them 40% of that. So that is 300 by 40, 120. Huh? 120. So 120 should reduce our investment. Sio ni mbaya sana. Imagine umeinvest unasikia unasikia hiyo kampuni imetengeneza loss ya 600. Unajua we are working in millions. So that 600 ongeza millions. Hiyo hata ni pesa ngapi? 600 unajua huko juu ni millions. So hiyo ni 600 P ama inafika B kweli? 600 ongeza 6 zeros ahead. How much is that? 600 million. And you just invested 6 months ago. Mpaka wanakuambia now kwa hiyo loss, this take for us. Help us in sharing 120. Hata waja hiyo, before hata ukiendelea kufikiria mambo ya hiyo loss, wanakuambia pia your investment has been impaired. See, there was impairment in it. That investment has been impaired. It has no value. It has been impaired by how much? 80. Hiyo ndio ile unasikia. Ukisikianga ile kizungu ya utafunzwa na dunia, usifikiri ndio sasa. Uliambiwa usiinvest. Hii mosho kuna group nyingine wanafurahianga. You know the people becomes very happy when they warned you and you refused. The spouses, when the spouse told you that's not, na ukaenda na kichwa ngumu, basi. Hiyo itakuwa wimbo kila siku. Si nilikwambia? So how much is this? 1720. Imagine you invested 19. Unajua si kitu serious. Iko tu umeinvest kama KQ. Unajua KQ inakuwa unpredictable. Leo unasikia wako sawa, kesho hawako tena. So you invested 1920, for example, KQ. That year, you'll invest July, 1st July. By December, unasikia wako na loss ya 600 million. So unaambiwa kwa ile investment yako, wacha tupunguze na 120. Na customers wamehama. So we have estimated that we have impairment of this much. So yako, so investment yako na sisi, ukitaka kwenda leo, tunakuandikia check ya 1720 instead of 1920. So you stand to lose 200 million. Sorry? So that is what you take up there. Investment in what? That is 17. Then investment in S, you bring goodwill. We calculated the goodwill. Please remind me that somewhere we calculated the goodwill. I can't recall the answer. What was our goodwill? 17.
6.5.
77. 27, 65. Ama kuna kitu kingine, just wait. There's something again below non-current. Your financial assets, that financial asset is no issue there because financial asset, you know what happens? You know, the parents had invested in the loan notes. Who can invest in loan note ni kama treasury bonds, bills, and the rest. To you, in your books, is that a liability or an asset? Where when you may invest, to some extent, you may invest for bonds. In the books, is that a liability or an asset? That is your asset. So parent invested how much? How much did they invest in S? The loan note. In a certain note there. Note number 2. So they invested 250. That 250, actually loan is a financial asset. It is a financial. So that 250 is what they are bringing in the books, but they invested in one of the group members. So no, so 250 minus 250. That one is an intergroup investment. But the good thing, it will add you no value. See, it's intergroup investment. They invested in S. Yeah, see, before investment for S. Why are you overthinking? Umesema S. Sasa unataka kudraga associate kwa associate imejaa nyolewa mpaka imechoka. Bado unataka kuiletea shida zingine. That was a different investment. How much is this? 45? 975. Current assets. We have to finish this question. Current assets. So that we start on foreign next week. Current assets. Current assets, to end the kazi. Inventory. Inventory, what do we subtract here? What do we subtract? UPI. UPI was 30. Yes, UPI was 30. So adjust. You get? 12,670. Next, receivables. Was there intergroup debts? Kulikuwa na mwingine alikuwa ndani ya watu wengine hapo? Were there people with some other people's debts? No, there was no intergroup debt. Neither was there cash in transit. So this one comes to 51. 51.50. Then we have cash and cash. Where are the cash? Where are you storing? 1980 plus 400. There was no cash in transit. So how much is that? 23? 80. 2380. Total assets. Total assets. Can you add all the assets? And add all the assets. All the assets comes to 66. 66, 175. Yes. Who asked a question up to where we have reached? So then let's go to equity. Equity and liabilities. Someone is saying something here. Brand. Tumesahau brand. So brand is an intangible asset. Unaona ule nasema, yes, that is what I was thinking about. Yeah, we forgot about brand. I acknowledge. There is brand. Brand inabidi umeleta hapo. Brand was 300, eh? You remember? Brand was 300. Then we amortized how much? Lazima tuwe amortization. Was it 25? Yes, it was 25. Sorry for that, but it's good it's seen before tuende kuitafuta huko mbele. So bring that brand. Brand was 325 amortization. So we are talking of how much? 270. Right, you do your adjustment. Nataka hapa mwisho total. So okay, adjust 275 here will be 40. 46, 250. When you adjust here with the 275, I'm going to talk about 66, 175 plus 275. 66. Yeah? 450. Now, thank you. Let's go to equity. Let's go to equity and liabilities. Equity and liabilities. Equity and liabilities. Chap. Equity and liabilities. Equity and liabilities. Na kitu mmezoea kwa equity, si ndio? Mmezoea nini? Leo naona hapo kutakuwa na issue. What are you used to? Parent only, eh? Sasa leo itakuwa parent only because okay, itakuwa hivi. Parent only bado. Ordinary share capital. Ordinary share capital. Parent ni ngapi? 8, eh? But you know what is happening? Parent gave out some shares to acquire that company. You remember? They were giving 1 for every 2. So you will add, those are parent shares. So you will add, they were giving 1 for every 2, but they acquired how many shares? You remember the 400? The 80% of 5. They acquired 400, but the par value of these shares is how much? 10. You know, they paid shillings 30. So no, the parent paid 30, but the par value of shares negapi 10. So in the share capital account, normal accounting across share capital account, you cannot post anything above the par what? The par value. Because even this 8, what is the par value of those 8? It's 10. So in the share capital account, unaweka hiyo par value 10. Then the extra, imebaki ngapi? 20. So walipeana 30. The par value is 10. That 20 you will take to the share premium account. So, yes. So these are shares parents gave out. Chapa hiyo. Please don't copy. Parents gave 1 for every 2, but they had acquired 4. At shillings 30, but we know in the share capital account you cannot post more than the par value. You can't. 10. When nasema ukiangalia neighbor share premium wametupea ngapi? 4 plus 1 for every 2 times 400 at shillings how much? 20. That excess amount goes to the premium account. That is how accounting is done. I got my balance. That is the truth. What is 6? Yes, lakini sasa kwa share capital account, we did an investment, which we don't care whether you end up. But sasa hapa kwa capital account, hautaona kwa CR12 imeandikwa ati shares of shillings 10, 12 bana. the par value must be uniform for all the shares. So ile kwa investment, there is no problem. But tena ukiangalia, when you take this plus this, utapata hiyo 6. When you do a capital account, you have to separate. The par value goes to capital, then the excess goes to premium. But huko juu hakuna haja ya separate because the investment unatafuta. How much is that? 8,000. So if the parent is giving out their shares, you add, you have to top up. Retained earnings, that is a story. Retained earnings, newcomers, you are to sorry. NCI, story for another time. And that one you skip. You bring what makes you happy first. Things which are not making us happy, don't want. So I want to go to non-current liabilities. Actually, we are finishing. All right, so non-current liabilities. You have what? 8% what? Loan notes. That will be 76 plus 2,000 minus what? Minus 250. See, so I'll invest 250 kwa S. So in the loans of S, 250 is here. Unajua one anatreat kama loan, mwingine anatreat kama investment. So kama investment ulitoa kwa non-current assets, then in the books of S unaweka liability pia unatoa. That is intercompany loan 250. Tell me what you get. $93.50. We proceed. You remember the deferred consideration? Yes. Deferred consideration that will be paid in future. It was 8,300, but there was cost to finance that deferment of 800 and what? 30. So that one you have to top up. That one comes to how much? 91.30. We are finishing. Next, current liabilities. Payables. Payables has no workings. 55 plus 52. 55 plus 52 comes to 10,700. Finally, current tax. Also, you just add 28 plus 23. How much is that? 50? 51. Total equity and liabilities will assume total assets. 66 for 50. 66,450. So we are only remaining with two unknowns. We have two unknowns. Which one do we start with? Nani kuna swali before tufanye NCI and retained earnings? Au kunaanza upati. Naona unaangalia hapo. So payables ni shida. Payables. Sio ndio free answer. Free ticks. Ni akili imeblock kidogo tu. Ni advance kama unajua. I know what can bring you problems. That one. Kwanza deferred consideration ndio ungesema hiyo inatoka, lakini za payables. Payables shida inatoka wapi? Ama tukuwekelee mikono. Maombi. Payables, those ones that you just add. Between retained earnings and NCI, which one do you want us to start with? NCI. Let's kick off with NCI. NCI. I don't believe it fast. NCI, they want to know their equity. So right here, NCI's equity. Their market value on acquisition is deemed to be their capital. So fair value on acquisition, when we acquired subsidiary, how much was the fair value of the minority? No, you can calculate it. Sweden note 4, which note? After acquisition, note 4. Note 4, it was how much? 1,800. So their market value in quotes, that was their capital when people started. That was their capital. Then any profit which will come in that company after acquisition, minority will get what share? 20%. So add post-acquisition profit. So post-acquisition profit. And post-acquisition profit, you have to adjust. So I'll adjust it here. How much is the post-acquisition profit? Check P&L. Because it was 6 months. Check the question. You know we had calculated it somewhere. Ebu check the profit attributable. Check the profit attributable to NCI. 260. Because they subtract the depreciation and amortization, it is 260. So I don't know whether mutaelewa. Post-acquisition profit is the profit which we got in the subsidiary after acquisition. So if you check your P&L, the last item in P&L, there is the profit attributable to NCI. Let Afra. How much? 60. Yeah, I will not disturb myself when things are easy. Yeah, that is true. They made this minus. Yeah, that's okay. Yeah. 2060. 2060. So bring here 2060. Can you use retained earnings as the balancing figure? Then we confirm. Then we consider it finished. I want to confirm it here. Mnapata ngapi? 12,110. Subject to confirmation. So up there 12,110. Yeah. 12,110. And they can retain earnings so that we confirm we are accurate. Retain earnings, parent, subsidiary, I'll bring post-acquisition. I'll bring their post-acquisition profit, even A, I'll bring post-acquisition. Which are impairment. So retained earnings, you know this thing you can do in so many ways you want. So retained earnings, check for me, H. How much is the retained earnings of H, which you can see with your own eyes in the balance sheet? Carry it down. The retained earnings of H, which you can see in the balance sheet, 12,100. Imebaki tu kidogo na ikwe 12,110. Tutoe wapi? 12,100. Kuna 10 mahali una fix ndio. Unasema iko sawa. Then you add post acquisition. Post acquisition profits in S. Post acquisition profit in S and even A. So in S, parent will take 80% of the profit that company made after acquisition. So 80%, unaona hiyo when we calculated CI, the profit of the subsidiary was 27 what? 30 for how many months? 6 minus UPI was 30, amortization was 25, depreciation was 10. Is that true? When you divide it to 60 and CI, the same post, but now you take 80%. Does it make sense? Yes, the same post acquisition, and CI took all this. How we got to 60, but now parent will take what percentage? 80. 80 of that post acquisition. Please indicate what they mean. 30 was UPI, 25 is amortization, 10 is depreciation, yes. Then you give them 80%, then they will not have problem with anyone. They will not create chaos. How much is that? If you take 80%? Hapo naona wakisema wanakuangalia vibaya hiyo asa yako ati sawa. Bottom is another issue. You have to finish first of all with 27, 30 times 6 over 12. Minus that is when you take 80. 1040. So this is 1040. That is 1040. Then bring A. A post acquisition is 40% times negative 600. But 6 over 12. They made a loss. Those ones made a loss. They made a loss. So how much is that? 120, which we reduce. So 120 we reduce. The only items I'm seeing maybe which are remaining, there was impairment in associates. Our investment was impaired. Impairment loss, I can't even apportion. Our investment is the one which was impaired. By how much? 80. Then on deferment, there was finance costs. So finance costs on deferment, it was how much? 830. That one will affect the parent's profits, definitely. Yeah. There is no any other expense. Can you please try to confirm? If it doesn't be, I don't know, but my thinking against that. You go sawa. Sawa means 12, 110, 12, 110. So can we mark? We mark. All right, let's mark this. So 10-10. Ama max ni ngapi? 10-10. So in the P&L you need 5 ticks, in the balance sheet you need 10 ticks. P&L 5, balance sheet 10. Balance sheet there is no credit. So can you tell me from the balance sheet, deep down your heart, which one? Today I know you will not say your Yolinat. But which ones will you get without struggling? After inventory, ndakosa. Sinyi ndio mlipe UPI. This one you have to get. Which one? You get payables, yeah. Charles. Yeah. Will you get payables? This one. These two. Yes, those ones we have to get. Which one? Which ones again? We need 10 checks. Cash. What to see overstate? To say some just struggle. Whoever has not struggled much, after this one you can get. But anybody who has not struggled should get 1, 2, 3, 4, 5. 5 over what? Twende kwa P&L. Yes, kwa hivyo. Twende kwa P&L. P&L. Tell me the ones you want to get. Tax. Tax. Distribution. Which other one? This one I know you will get. By the time you're going to exam, I know you will get that and this one. Without struggling. Here, without struggling, I know you will get 8. That is 8. 4 is 8. 1 8 over 10 plus 5 over 10. Here they have. 1 you put 13 over 20, and you have not struggled. So then you struggle kidogo. So unapita. But you ukishapata hiyo kwa group uko sawa. You are far much ahead. The problem with that question is this one here. It can make you get 0 here. So you be very careful. Write for me there IS21. So of what we have been doing, there is no element which is new from what we did in section 3. So I want to climb kidogo. IS21. IS21. Effects of foreign exchange. Effects of foreign exchange rates. Effects of the foreign exchange rates. So there is something less than 1 page. Wacha niwapatie muniandikia over the weekend. Some small notes we come, we discuss. One kama naweza chapa hesabu. So last semester, that's what they brought in group. They brought foreign subsidiaries. You find parent is in Kenya. Subsidiary is operating in which country? So here to talk to Uganda. Uganda has brought us some problems. Which country? Yeah? The US. Parent anaweza kuwa Kenya na subsidiary iko US. It is even possible. Kimbeleka yake Somalia. So it's like 5 evening. I was trying to think which class is this one. So I've shared is less than a page. Just lakini kuna watu wengine watasahau. Hiyo siku watu walikuja wakidiscuss what was when was it shared? So I've shared, write it down. We discuss to find a sum. By Tuesday, God willing, to go to Maliza foreign. Tuesday, yes. Then Saturday at time like today. We start on disposal of subsidiaries. Hiyo itakuwa tarehe kesho 19 plus no leo ni 18 plus 7 25. So 25th. See, after that we step, then from step the cash flow, then group is over. But tomorrow we are meeting for deferred tax. So I'm going to talk with Mwalimu FM because I'd informed you we meet at 8:30 and even day class niliwaambia, but early morning nimesikia they have waliambiwa wako na FM 8. So I'm going to negotiate with their teacher kama yeye anaweza change because deferred tax ikienda sana 3 hours. So tukimit 8:30 maximum 11:30 tutakuwa tumaliza. Ndio wao. So ni mnaweza kuja wenyewe wanataka kwenda mahali, mnaweza kuja na watu wako hata waweke hapa. Alafu tukimaliza muende. Wacha 8:30. In case kuna change nawaambia, but I'm going to kumwambia mwalimu hiyo ikati can be better for us. Susan sawa.